Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 333 on July 26, 2024. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Medical Properties Trust, Robinhood Markets, and Marathon Digital Holdings, and we discuss three new trades on CleanSpark Inc., Roblox Corporation, and CVS Health Corporation. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the equity markets finished the week with the two major indexes seeing mixed results once again. The Dow Jones Industrial Average picked up 301 points, ending the week at 40,589 points. The S&P 500 index lost 45 points, closing at 5,459 points on Friday. And now it's time for the topic of the week. The topic of the week is assignment. A good friend of mine reached out regarding a trade that he executed that was mentioned on the show a few weeks back. It was a put credit spread. The market fell $3 lower and the trade had gone against him quite a bit. Now, he actually executed the trade for 7 cents better than I even mentioned on the show, but with prices of the underlying stock having gone down so much, the trade was definitely at a loss. Now, one day, his brokerage let him know that he had purchased 100 shares of the stock at the strike price of that short option. He wasn't exactly sure what happened, so he called me and I was able to explain it to him. The person who bought that put from him exercised their right to sell 100 shares of stock at $19.50 per share. Now, even though the stock price was $3 lower than the strike price, the friend who sold that put option had to take the other side of the trade, meaning he purchased 100 shares of stock for $19.50 per share. Now, the friend owned 100 shares of stock and owned a put option that was deep in the money, and that's the other side of that spread. I told him that exercising his long put option would offset the shares of stock that he was forced to buy due to the put option that he had sold. If you've traded options and specifically sold options, you most likely have experienced a similar situation. It might feel uncomfortable the first time it happens, but it truly isn't anything to worry about. If you trade a spread and both options are in the money, all you need to do is exercise the other option. That recreates the exact scenario that you anticipated when you entered the trade. Once my friend exercised the put option, he was then able to sell stock at $19 per share. Just to share the numbers real quick, he bought stock for $19.50 and then sold stock at $19 per share by exercising that put. That is a loss of 50 cents or $50 in real terms. But you have to remember that he collected 25 cents to sell the spread right from the start. Suddenly, a loss of 25 cents isn't so scary. So being assigned stock on a short option position isn't a bad thing. Just remember that it always comes down to simple math. And if it happens to you within a spread scenario, meaning you either had a long option against it or maybe you owned stock against it, like in the case of a covered call, it's totally fine. Like in the case of the covered call, that option being exercised would actually lead to a sooner collection of the profit. But if it happens within a spread, like let's say that the stock price of your trade, of your underlying trade, ends up finishing right between your strikes, then you just have to close out the trade on the stock side and the trade is over. But if both options are in the money, then it's not a bad thing. It's working out just as you planned. So go ahead and exercise the other side of that option and all will be well. But it always comes down to simple math. So just grab a pen and a sheet of paper and write it all out so that you fully understand. All right, so let's get into the trade review from last week's trades. We're going to start off with our covered call. We looked at Medical Properties Trust, symbol M as in Mike, P as in Papa, W as in Whiskey. At the time, the stock was trading for $4.80 per share. I looked at buying stock and selling the August 5 call at 33 cents, which could give us a 11% return in 4 weeks. Well, shares of Medical Properties Trust grew 50 cents, ending the week at $5.30 per share. The call option that we sold gained 32 cents, leaving us with a net profit of 18 cents if we were to close the trade out immediately. Now, with the stock above $5 per share, we stand to earn 3 times that amount at expiration. So we typically look to roll the strike of the option lower if the trade goes against us. You could roll the strike higher when a covered call works out as well. You'll definitely need to do the math and understand what's at risk. For instance, rolling the strike higher might increase the likelihood that your option expires out of the money, which would leave you with the shares of stock beyond expiration. That can be a good thing if you want to continue selling an option against it in the next month, or a bad thing depending on your goals. Maybe you want to get out of that stock trade, or you want to have the cash liquid for another trade. So for now, no adjustment is needed on this trade at all. It's working out as is, so no need to change it. If it ain't broken, don't fix it. And as a warning, that was actually the trade that worked out this week. The other two, not so good right now. So let's go ahead and get into that. The credit spread on Robinhood Markets, symbol H as in hotel, O as in Oscar, O as in Oscar, D as in Delta. At the time, the stock was trading for $23.41 per share. I looked at selling the August 22-21 put spread at 36 cents. That could give us a maximum possible loss of 64 cents per spread. Now, shares of Robinhood pulled back $2.21, ending the week at $21.20 per share. The out-of-the-money put spread that we sold is now 80 cents in the money. The spread increased in value 22 cents, which represents our loss on the week. Now, you can turn this into an iron condor by selling a higher strike call spread against this put spread. You could sell the August 23-24 call spread at 22 cents, effectively eliminating your loss on the week. I always get a little suspicious when it works out so perfectly. Overall, I'm still thinking this stock could push higher over the next 3 weeks, so I might lean towards holding off a few days before making an adjustment just to see if it heads higher again. This trade was a loss on the week, but with a bit of management, you can lower losses even more and possibly turn this into a profitable trade. The other option, if the stock did continue to go lower, is to turn this short spread into a long spread. And if you want help doing that, or if you need to learn how to do that, just shoot me an email and we can talk about it. All right, so our final trade from last week was a debit spread on Marathon Digital Holdings, symbol M as in Mike, A as in Alpha, R as in Romeo, A as in Alpha. At the time, the stock was trading for $24.73 per share. I looked at buying the August 23-24 call spread for 65 cents, hoping for a maximum gain of 35 cents, or that would be a 53.85% return in 4 weeks. Now, shares of Marathon Digital had a rough week, going down daily other than today, Friday. The shares lost $3.16 per share, closing at $21.57 on Friday. The in-the-money call spread that we bought is more than $2 below the break-even point, which means we are well justified in making an adjustment. My favorite adjustment for a debit spread or a spread that I bought is to turn it into a short spread by buying back the short option and selling an option that is closer to the money. For instance, you can sell the 22-24 call spread at 41 cents. Now, I'm actually not a fan of this adjustment just yet because I actually think the stock could return a little bit higher. In addition to creating a short call spread, you can also add a short put spread to make this an iron condor and lower your overall risk. Just remember to make sure it's a lower strike put spread. And of course, if you believe there's a good chance the stock will head higher again, you'll want to just hold off on making the adjustment at all. That's always the caveat to making these adjustments. You may be justified in making one, meaning that the stock price has moved below our break-even point, but with 3 weeks left until expiration, anything could happen to this stock. At the start of the trade, our risk was capped. Don't ever underestimate the value of that. Even if the trade goes against you, the risk was measured and accounted for from the start. That's why I don't freak out if the trade moves against me. I just get to sit back and decide, is there a way for me to lower my overall risk, or is there a way for me to increase the likelihood that I'm going to end up with a winning trade? Sometimes that means turning a long spread into a short spread. Sometimes that means turning a short spread into an iron condor, just to take in a little bit more capital and lower my overall risk. Either way, as long as you understand options, you have more options for how you're going to manage the trade. All right, so that's it for the trading review of last week's trades. This week in the news, we had a bunch of inflation data released over the course of the week. And on Wednesday, July the 31st, the Federal Reserve Open Market Committee will make an interest rate announcement. That's this upcoming Wednesday. So this has been one of the largest drivers of the market for quite some time. People want to know if the Fed is going to start it. Well, number one, will they lower the interest rate? And then number two, when are they going to start? So definitely be aware of that happening on Wednesday. I think it's Wednesday afternoon at 1 p.m. Central. That's 2 p.m. Eastern time. So just be aware and be ready. Of course, on this week's show, all new trades will use the August 16th expiration for monthly options. So let's get into it and start with our covered call. Looking at CleanSpark Inc., symbol C as in Charlie, L as in Lima, S as in Sierra, K as in Kilo. The stock ended the week at $17.12 per share. I'm looking at buying stock and selling the August 17 half call at $1.75, hoping for a return of 12.44% in 3 weeks. Now you enter this trade by buying shares for $17.12 and selling the August 17 half call at $1.75. This trade makes the most money if stock prices finish above $17.50 per share. The break-even price on this trade is $15.37 per share, and in real terms, the stock purchase will require $1,712, and you'll collect $175 for selling the option. Next up, we have the credit spread on Roblox Corporation, symbol R as in Romeo, B as in Bravo, L as in Lima, X as in X-ray. The stock ended the week at $40.50 per share. I'm looking at selling the August 40-39 put spread at 39 cents, which could give us a maximum possible loss of 61 cents per spread. Now you enter this trade by selling the August 40 put at $2.69 and concurrently buying the August 39 put for $2.30. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $40 per share. The break-even price for this trade is $39.61 per share, and in real terms, you'll receive $39 per spread that you sell and have $61 at risk. And our final trade on the week is going to be a debit spread on CVS Health Corp, symbol C as in Charlie, V as in Victor, S as in Sierra. The stock ended the week at $61.01 per share. I'm looking at buying the August 60-61 call spread for 60 cents, which could give us a maximum gain of 40 cents, or that would be a 66.67% return in 3 weeks. Now you enter this trade by buying the August 60 call for $3.30 and concurrently selling the August 61 call at $2.70. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $61 per share. The break-even price on this trade is $60.60 per share. In real terms, you'll pay $60 to enter the spread, and your maximum gain is $40 per spread. So that's it once again for this week's show. Thank you guys for coming along with me. 333 shows. I'm simply in awe that this podcast has gone so long and that you guys continue to listen. And honestly, I'm only getting started. There are a bunch of things that I'm looking at bringing forward in the coming weeks. We kind of dabbled with that Discord channel months ago that didn't go as well as I wanted. However, I got a fix for it because I really want to create community that will allow you guys to engage with each other, learn from each other, and honestly, share trades with each other. Like, I love being able to hear how my students are using this same information because they oftentimes will add their personal flair to it and they'll see things that I don't see in the market. And that is a beautiful thing. That's the beauty of just having community, is you end up with some collaboration. So I have set up a Facebook group. I'm going to be growing that in a couple of different ways, creating some more content for that group as well. So if you are interested in being part of that, definitely shoot me an email. So I'll let you know when it's up and going. I'll send you an invite once it's up and running. But for now, just know there's more coming. We're just getting started. I'm not tired at all. I appreciate the emails. In fact, I have an email I need to get back in touch with, I believe, on some historical option pricing. So if you are the one who sent that email and you happen to be listening, just know that I'm talking about you. Otherwise, I'll be back in touch. You guys will hear from me next week. Hey, make this a great trading week. Expect some volatility in that Tuesday, Wednesday, and Thursday timeframe centered around the interest rate moves. So if you're trading intraday, be aware. If you're making short-term trades, be aware. And also, if you have longer-term trades on, just know that prices might move around a bit. But that doesn't mean they're going to stay fixed wherever they settle. Just give it some time. So this is going to be big news, especially if they do make a change. So we'll see. All I can say is things will not stay where they are today, and that's part of what makes trading so much fun, is that there is constant movement, and there's a reason to keep getting better at your craft. There's a reason to keep watching the markets, and honestly, the markets making this show really easy because every week there's movement. There's just change. So thank you guys for listening. Hey, thank you for sharing too. I can tell you guys have been sharing this podcast with your friends, your loved ones, your colleagues who also trade options. It's fantastic. Thank you for the emails. I've been getting more emails from people lately. And like I said, I respond to each of those personally. So if it takes me a little while to respond, it's just that I got a little busy, but I try to stay on top of it. So, hey, have a wonderful weekend. I hope you're having an incredible summer. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.